Welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review some stocks, commodities, review the currency markets, and just get a basic idea of what in the world's going on, talk about what's happening these days. Of course, there's a lot of stuff to go over, so without any further delay, let's go ahead and review all of this key information. Now, for starters, we are, like I'm saying, what I was saying a couple days ago, U.S. dollar index did find a firm base, and it has traded off of that. Now, that was partially because I did see it go sideways off a Bollinger Band. Now, another thing is that not only, Bollinger Bands don't always work, but in this case, it actually did, and the main reason why it kind of did was because we are ending quantitative easing 2 by June, and that's basically what the Federal Reserve plans, which is basically a month from now, so 2 months from now. And the thing about it is that markets trade on future expectation. I mean, the market doesn't just sit around until June comes around and then they say, oh, maybe we should go buy the dollar. No. See, people buy into hype, and especially the institutions. They anticipate events and then they act prior to their occurrence. Now, once the Federal Reserve stops quantitative easing 2, by then nobody will be surprised, and chances are you'll probably see a pullback in the dollar, and then it will continue going up in valuation. Now, this is kind of a conspiracy theory here, and I'm not too big on conspiracy theories. But one reason why the Federal Reserve is not going to, do quantitative easing 3, not anytime soon at least, is to basically give Washington, or basically the White House, a very good reason to authorize a third round of quantitative easing. Well, what would you need to do to get that third round of quantitative easing? Well, first of all, since this economy is so weak, it basically relies on easy money, easy dollars. And without it, the economy just doesn't seem to get the growth it needs. The stocks don't get their growth. And if I want to go ahead and point you guys to a chart, I'll show you on a 2-year chart. And I'm going to get rid of all these trade triangle signals because, I mean, they're good, but I mean, I have to review what happened in May. But basically, when May went around, all you basically saw was a huge rally in the dollar index. And that was mainly because quantitative easing 1 was basically coming to an end. Now, you also saw, right after that, pretty soon, the Federal Reserve comes out in August or something like that, and they announced quantitative easing 2, basically. And what happens is that initially, the dollar index did kind of shoot up because everybody was kind of expecting it. But then after that, because people were already short all the way down here. I mean, once the news comes out, people don't care. I mean, they're just gonna close their short positions. So you get the dollar index going a little bit, and then it continues going lower. And from there, the rest is history. Stock market has had a great rally ever since then. If I go ahead and point you guys to the Dow Jones Industrial Chart, you guys will notice over the 2 years, once we had that major flash crash correction, plunge protection squad, that's what some people like to call it, or basically the Federal Reserve, comes out with quantitative easing somewhere around July to October. They get quantitative easing 2 authorized to go ahead and start pumping in that easy money, and obviously you see the Dow Jones Industrial Average continuing to go higher. So the point here is that without quantitative easing, markets are still weak. And because of that, markets do trade on future anticipation. We also have May earnings season basically earnings season is basically starting to come to a close. So now you basically are reduced to 3 reasons: fundamental or economical reasons, or basic demand reasons. One being end of earnings season is one reason why stocks will most likely have their typical weakness that you will see after just about every single earnings season. But also, you also have the sell in May effect, where a lot of institutions sell their positions prior to going on vacation. So that's your second reason. And the third reason is that quantitative easing is going to end. And when people are about to sell in May, along with the anticipation of quantitative easing coming to an end, you add +1 + 1, and obviously a lot of people will be closing their positions before going on their vacations, their happy vacations out at Jersey Shore, where obviously if you guys have watched the Jersey Shore, the point is that people do some really retarded stuff over there, but that's kind of the point of going on vacation with the kids at the Jersey Shore. Now, the whole point is that since people are going to go on vacation anyway, they're going to close their positions since we anticipate quantitative easing to come to an end. All the more reason to sell our positions, and not only that, people are selling the news hype. So there are basically 3 reasons why people don't want to be holding on to stocks. Now, moving on, you do see the Euro-US dollar having a major pullback. Why? Because we've been overbought for quite a while now. If you guys go ahead and look at the 2-year chart, you already see this huge, massive rally. But what happened back in May? All right, May of 2010. You saw the euro. We can go back to May 2010 flash crash, and you basically see the euro US dollar collapse all the way down to basically 1.24. That basically gives you a basic idea of how the rest of 2011 will look for the euro. Because what happened? Well, after the Fed announced quantitative easing 2, you obviously see this huge long-term rally in the euro. Right now, since the euro is a bit overbought, we do have a lot of downtrending indications, and not only that, the sell-off is very justified. After all, quantitative easing is coming to an end. You have rumors about Greece kind of exiting out of the eurozone, and this kind of follows sort of what George Soros and his theory stated, that weaker EU states will want to get out of the euro because it's not very beneficial to themselves. Therefore, you might see a breakup of the euro or the beginning of it. At least what based on what George Soros surmises with his reflexive theory analysis. But the whole point here is that the euro is starting gonna have and will most likely have a pretty major pullback. And you're already seeing it right now, and this is probably just going to be the beginning of it until the Federal Reserve comes back and they start issuing in that quantitative easing 3. Now, will that happen? Probably, but the Federal Reserve needs to have a very good reason before justifying it, aka Ben Bernanke needs the market to crash before he can say, hey guys, I got a solution. I'm going to do a quantitative easing 3, and then everybody will accept quantitative easing 3 because it's the only way to avert some sort of economic catastrophe, basically. So, again, quantitative easing 3 is going to happen after people can acknowledge the need for it, and right now there's absolutely no need to do quantitative easing 3 until you see a major market correction. Now, as far as the US dollar, Chinese renminbi, yuan, you are seeing the US dollar find somewhat of a base, but I'm not too convinced. I mean, the Chinese government was extremely clear about ending inflation. So, there's only so much people can do. I mean, yes, there could be a speculative reason as to why, since the Federal Reserve is ending POMO, therefore you could assume that since not as much money is getting made, that the US dollar should start to regain some of its value. The only flaw with that, when we compare it to the USD to the CNY, is that the CNY is being manipulated by the Chinese government to basically go down in value. Therefore, I really can't recommend any trade in this. I wouldn't be long, I wouldn't be short. I would just avoid trading the US dollar CNY pair altogether. As for the British pound, the British government did not raise any interest rates because people were expecting it to fuel their continued rally as the US dollar was going to end permanent open market operations. With the end of POMO coming soon and the sell in May effect, this goes for Forex as well, because believe it or not, institutions are very, very, very involved in the currency markets. Just the way it works. It'd be naive to think otherwise. But the point here is that the British pound is going to most likely weaken to the US dollar. Just expect that. If that's the way it's going to be, that's the way it's going to be. You could see some support at the 50-day moving average. Maybe a small bounce off it, if not that much. If you see it, if you're a trader and you're an aggressive trader, you could possibly take a bounce off that 50-day moving average. But I would be very risk averse. For those longer-term trend followers, it's much better to be shorting the British pound against the US dollar than it is to be looking for bounce opportunities. Because you know what, a bounce opportunity is probably going to last you for one day on a candlestick, and that's about it, off of a typical moving average. Moving on, crude oil has had a massive pullback, and obviously oil stocks are taking the brunt of it right now. Therefore, you're seeing Dow component stocks take a huge hit, especially those component stocks that are attached to oil, like Chevron and ExxonMobil. Those are the world's biggest, some of the world's biggest corporations, Chevron and ExxonMobil. The whole point here is that it drags down the indexes. Therefore, anytime you see a huge plunge in oil, you're going to see a huge plunge in oil companies. Therefore, the S&P 500 was going to perform that much worse. Therefore, on Friday, you saw the S&P kind of go up a little bit, and then it started pulling back because a lot of those oil companies did have a lot of weight, and that weight obviously plunged the rest of the ship. Now, as for the Treasury bond market, Treasury bond markets are going to typically go higher. As you guys can see, interest rates are most likely going to fall in a deflationary environment. Therefore, Treasury bonds are also good. Another reason why Treasury bonds are good is also because of the fact that as stock markets fall, people have a flee to safety mentality and they buy the Treasury bond. Also note that Treasury bonds and the US dollar are very correlated. When the US dollar goes up, chances are you're going to see the Treasury bond market go up as well. That's why the June 2011 Treasury bond contracts have been going up and will continue this upwards trend. We have a monthly, weekly, and daily trade triangle pointing towards an upwards direction, and I do agree with that thesis. As for the volatility index, I would avoid trading it. There are better shorting opportunities out there. If we don't see a major drop all at once, you're not going to see the volatility index go up as much as you'd probably like. Therefore, this market is kind of a little different. I'm expecting a slow downwards trend until we get a pretty major crash sometime, but since we have all these measures taking place to prevent a major crash all at once, you're probably going to see a continued downwards trend, and that's not a lot. That's not enough room for the volatility index to go up on. Rather, I'd look for shorting opportunity in specific stocks that have been extremely overbought, which I'm going to move on to right now. This is a stock that I think has been overbought for quite a while. The company is Priceline.com. Ticker symbol is PCLN. I'm going to go ahead and review the five-year chart, and obviously, as you guys can clearly see, it has gone all the way from $50 back in 2007 all the way up to $550. That is a 10 times increase in valuation. On top of that, it has a 57 PIs to earnings ratio. Not only that, if you guys look, it has had a continued downwards trend over the past couple days, and it has broken the 20-day moving average. This is a clear overbought candidate, and not only that, since stocks are dropping as it is, why not short a company that has already been priced to the max? Along with that, it has broken the 20-day moving average. You see a percent K cross below the percent D, and not only that, volume is reaching new highs. And remember, when you're selling into a lot of volume, that is very good. That means that you can be extremely bearish on a company just like this one. Anyway, I hope that takes care of everything. If you guys are interested in watching my videos, please be sure to go ahead and subscribe to my YouTube channel. If you're interested in my charting software, please be sure to go ahead and check out the link right below. Thanks a bunch, and I'll see more of you guys in the coming months and weeks ahead.